How do you navigate this as an investor, especially given the fact that we went into this administration just 47 days ago with stocks overvalued?
I think you're exactly right. The key issue so far this year has been the market's struggle to assess the forward trajectory of the economy. And as you noted, we entered this year with investors very optimistic about what that growth path would look like. And over the last few weeks, we've seen a very sharp downgrade. Now, the good news is, if we look at where things are priced today, they look much more reasonable in our view. And so our base case here is still the economy is in good shape. It's growing. We saw a confirmation of that this morning. Earnings are still growing. And that means the equity market should be moving higher as well.
All right. So in light of that, then, where do you put your money to work right now? Especially as we've seen yields come off pretty dramatically. We've seen this rotation out of things like more economically sensitive parts of the market, like cyclical sectors. What do you like?
I think you're exactly right. There's been so much volatility on the cyclical side that rather than take a strong view today, going all in on cyclicals or all in on defensives, we're trying to find a balance. And that means some sectors on the cyclical side and some on the defensive side. On the defensive side, we've been recommending healthcare, and that's done very well this year, one of the best sectors in the market so far. And despite that outperformance, it's still trading at nearly the lowest valuations in history. So that's very attractive to us. And on the cyclical side, material stocks look very attractive. They've dramatically underperformed the commodities to which they're usually linked. And when you look at the recent headlines of potential fiscal expansion out of Europe and maybe some focus on domestic reinvestment here in the U.S., those policies should benefit the sector as well.
Is there a way, Ben, to know how much of this is headline driven? I know the headlines. Listen, to be fair to the media, we always need a reason for something. Stocks sell because of blank. Insert reason here. I've been doing this almost 30 years, so I've seen a lot of reasons why stocks go down. How much of this is tariffs and uncertainty versus simply algos, algorithms, changes in buyer or seller habits? And just like the other 5% declines we've had in the last 15 years.
I think you're getting into a key point here. So before we even think about what's going on, what will happen next, we should just look at that typical experience when the market draws down. So if you don't know what's coming out of Washington, D.C. or the economic data, but you do know that the S&P 500 has just declined, history tells you that's usually a good buying opportunity. In fact, over history, an investor who buys the S&P 500 down 5% generates a positive return over the next 6 months 85% of the time. So one option here.
We're going to call this Optimism Friday. I just made that up. Can you repeat that stat? Because it sounded kind of good.
It's incredibly good, right? The idea is if you don't know anything about the outlook, all you know is the S&P 500 just declined, and you're a buyer, history tells you over the following 6 months, you will generate a positive return 85% of the time, an average return of 8%. So that should be to you a signal that if you don't have a strong view on the economy and you don't have a strong view on policy, and all you're doing is looking at the market, you should start, rather than panicking, thinking about where I want to be buying.